It's 5 o'clock in London, it's midday in New York, midnight in Hong Kong, 2 a.m. in Sydney, 9 a.m. in San Francisco, 9:30 at night in Mumbai. Greetings, good morning, good afternoon, good evening, depending on where you are in the world. My name is Patrick L. Young, the IPO-VID Livestream, Series 31, episode number 1. In the aggregate, that puts us at 181 episodes. Starts here. We begin with the sad news. Our co-founder, my muse, my awesome wife, Beata, remains missing. I appreciate that you all want to enjoy the wonders of this fabulous live stream, and I apologize for the personal nature of this note, I must interrupt with a personal tone, beyond the business of bourses, beyond the world of women on it, but also contiguous to both our market structure and indeed the world of women on it, where Beata has worked so hard for women entrepreneurs, women in IT, women directors et al. This is truly the hardest message I've ever had to deliver, so please bear with me. My brilliant wife, business partner, inspiration and muse, Beata Young, went missing a month ago on June the 16th while swimming off the coast from our Caribbean idyll. Police investigations are ongoing. Please may I ask you to respect this investigation and not indulge in public speculation. I will endeavour to respond to all DMs as best I can, but as I can appreciate, these are difficult times. To all those of you who wish to pray or send a message to your God, regardless of faith, or just to the universe send some energy, please do so. We all hope for a miraculous return of an incredible woman. All our offices remain open, including Women on It, Exchange Invest, and everything else. I would like to add a huge word of thanks to our amazing team who have continued to work diligently. We continue to publish Exchange Invest. Our social media clients are fully covered, and most importantly of all, we intend that Beata's work through Women on It will continue as it does to this day. Our team intends to continue Beata's work as a beacon of light and inspiration for women in tech, in boards, and female entrepreneurs across the world. From that point, Beata's protege, Jamil Navarroza, will take over presenting PhD, Positivity Hack, delivered on the Woman On It channel from Wednesday, the 16th of July. And we are all behind Jamil, and we wish you every success, team, in making that happen in Beata's name. When I have any news, we will update you on the situation. In the meantime, please spare a thought for the brilliant Beata Young. Thank you. You can also find this message on LinkedIn and elsewhere, ladies and gentlemen. Back to the parish of exchanges, SEBI has fined Jane Street, the proprietary trading firm, no less than 4,840 crore rupees. That's a fairly whopping 565 million US dollars. And I think before I front run their wise insights, our panel are going to be eager to discuss this. At the same time, over in Chicago, the old school floor traders have finally got their day in court against the CME. And indeed, there's an issues and big issues alert. Zimbabwe Stock Exchange self-listed last week, while Indian brokers are salivating at a likely upcoming beauty round concerning the now finally seemingly fast-tracked NSE India IPO, which we've been eagerly awaiting for a generation. And even more incredibly, after only a decade or so of chaos, frankly, in India, a resolution may be happening for the NSEL debacle. Great news also from Kazakhstan. A proposed national monobourse is no more, with both KESA and AIX in Almaty and Astana, respectively, now free to build their markets independently. Our guests today, ladies and gentlemen, it's our second panel. We've got Mark Beddis and Berg, Robert Barnes. The topics, Jays for July, Jane Street, and more. Fresh from our successful experiment last month, IPO-VID 181 is featuring another fascinating panel to discover market structure, news, views, and matters of the moment. Mark Beddis, well, I think he needs no introduction, but we'll give him one anyway. Recently retired from CBOT, having been a co-founder of Block Venue Bids. Mark has a lengthy pedigree at the nexus of tech product development and markets. Anne Berg is a leading expert in commodities, commodity futures, and food security issues. She's a former grain exporter, futures trader, and CBOT director. While joining us for his first panel appearance now is Dr. Robert Barnes, co-CEO of BPX Digital Securities Exchange, who's been CEO of two successful trading venues, Turquoise and the UBS MTF. Robert holds the esteemed position of being an honorary fellow of the Chartered Institute for Securities and Investment. Gosh, so let's kick off and get straight into it, team. Mark, maybe you might like to lead here. I'm not sure where in the world you are today, so you can start with that if you're back home in Vancouver or not. But indeed, Jane Street and SEBI. Talk a little bit of that. I mean, that's a whopping fine $500 million.
Yeah, well, yeah. I'm in Vancouver. That's right. I'm o'clock in the morning here, and this is really interesting. This Jane Street case. When I first heard it, the idea that Jane Street was the kind of organization that would engage in market manipulation struck me as kind of outdated concept. All right, they are, as big a prop firm as they come, and there has been a history of market manipulation in that segment over the years. But I think the notion is actually outdated. I doubt very much whether the rocket scientists at Jane Street spend their time thinking about how can we manipulate the market. I think their business model has been for a long time simply the identification of anomalies between prices, correlations, hidden correlations, very much a quant-driven machine learning, and now we would all call it AI approach to trading. Now, options market making in particular, specifically, is that is you could say that's a sort of ring-fenced activity on its own, and that it's the way in which the likes of Jane Street manage that business would be strictly taking the options risk position, hedging it with the underlying, and so forth. But I think even there's a degree of cross instrument, cross product hedging, if you like. It's not really a hedging process. It's an arbitrage process. So my first reaction was that I couldn't see how. There's a misunderstanding going on there, and that if you were to dig into the actual trades that were being done and analyze them properly, that there would be that this would not be market manipulation. This would be arbitrage and hedging, and I still believe that's the case. But you have to keep an open mind with all of these things. It's not for me to go around defending one of the biggest prop trading firms in the world. That's just my interpretation of what I've dealt with them as a firm in the past, and it's my interpretation of of the way that they handle this. So, for me, it would be interesting to see how they deal with the appeal. But I don't want to cast aspersions on SEBI, but there is a bit of a history there with Jane Street being involved in a big dispute with ex-employees who were accused of stealing their trading strategies, and it came out in court that the trading strategy in question was actually on the Indian market. So is it possible that there's a degree of annoyance over there in India at the fact that their good name got dragged into this lawsuit, and what the hell was going on? I think there's an element of that in there as well. So that's my take on it as we speak now.
Anne, you've got a lot of experience dealing with SEBI, or at least you've been observing them, as I have for many a year. What do you make of the whole thing from a more commodity perspective?
Well, I dealt with SEBI when shortly after India lifted the ban on futures trading in commodities. Then they almost immediately shut down the wheat market. It's a kill the messenger kind of project, because the wheat prices, it was the 2008 food crisis was just starting. So the wheat prices went up 20%, and that was it. They simply said, well, it's too much speculation on these commodity futures. So they not only shut down the wheat, but they shut down all sorts of other, what I would call exotic products. Guar gum, I think, was one of them, and a few other food products, and dal, these lentils that they traded. So on the one hand, you've got what I consider as kind of a paternalistic agency of SEBI that wants to protect its countrymen. But, on the other hand, I'm not sure that this whole situation wouldn't have come to light like this if it weren't for the statistics being bandied about that the retail investors in India lost a whopping $33 billion, I think, in trading over the last 4 years. And, of course, one of the entities that profited from this was Jane Street, who made, I think, $4 billion. I could have the numbers a little bit off in the last 2 years. So start with that. So, and I think as much as I think, yes, for what Mark said was that, we need to give some more time and not cast aspersions on, the regulator and so on. I think from my perspective, what you're seeing is an asymmetry in, number one, knowledge base. You've got these day traders who are trading in one-day expiry options, apparently, and you've got large firms like Jane Street, who probably has the most sophisticated algorithms to trade in the underlying stocks and the futures and capture this arbitrage in the options. This is my understanding of what they did to make money. So, but it's this asymmetry that plays a part here, because the Indian options market apparently is bigger than any other options market, from what I understand. Somebody can correct me if I'm wrong on this, by something like 9 times. So you've got a leverage asymmetry, all the leverage that's put into the options market versus the stock and cash market, information asymmetry, and that, I think, in part is what caused some of this profit taking by Jane Street, who, as I say, is just more sophisticated.
Yeah, I mean, it's an incredible number, actually. The Indian, I mean, it's fascinating to think. I don't know, I did due diligence for some investors. I hope they're still in there at the moment. When was that? Over a decade ago, we were in Mumbai doing due diligence on NSE. And I mean, the big hole in the business at that point that I identified was single stock options, because they didn't have any business whatsoever. And now they're the biggest single stock options business pretty much anywhere on earth. I mean, even the US market is relatively up there with them, but nonetheless, it's an incredible number of contracts, not as much value as the US, I don't think. But it's fascinating how this has been going on, and SEBI is deeply concerned about what's happening to retail investors and so on. But it seems to me there's a big difference between market manipulation and just purely what is arbitrage. Robert, chip in. You began your career in the futures and options business, as we well remember from the live floor.
Well, I do recall that we both shared the privilege of being yellow jackets on the live floor, Patrick.
Absolutely.
And I remember the introduction of the electronification of the markets following the internet around 1995, which led to this incredible book, Capital Markets Revolution, which celebrated last year. So well-deserved, Patrick. What I recall, particularly in the underlying, in terms of cash equities, probably around 2003 was the year that you probably started to see the modern version of electronic algorithms starting to appear in a lot of the developed markets, and particularly in Europe, where UK was the biggest market, followed by Germany as a single country, and then France, which would obviously be into Euronext. What was interesting is that as the electronic algorithm started to develop, the question would be, is there an opportunity to scale the benefit where through the smaller and smaller trade sizes on the order book? Just imagine if you have a large number of bids, but a large number of small trades give you a large size on the bid, and then someone sends a small size to hit. Stochastically, over time, the average trade size comes down and shrinks. But at the same time, you're trying to design these algorithms to give the best result on a consistent basis, a definition of best execution for clients. What I was impressed with was, given that so much institutional business was driving in Europe, at the same time in Asia, by the time you get out to about 2007, a year before the big global financial crisis, there was a lot of interest in scaling this out into Asian markets. And in some Asian markets, some of the rules actually made the way that banks were processing, business in Europe, technically illegal. I remember there was a great opportunity to, raise this with some of the authorities in Thailand, who said, well, in fact, they're willing to be progressive reformers, but they can't make change unilaterally. Why not come and make the case directly in Thailand? I remember we did that in 2006. We had a presentation to the entire community, in Bangkok. Then the community had its own kind of private meeting a month later, and then the exchange ended up changing the rules, and then activity started to take off. I do remember a positive experience with SEBI, also trying to learn, very kind of competent people that we had the privilege to meet with, who then also if I recall right, probably the 3rd of April, 2008, where they actually issued the document that said, electronic trading through direct market access would be possible. So I have to say, in this particular case, I caught the headlines by reeling my daily pith off the Exchange Invest. But I have to say, I probably got more detailed information which I could refer, viewers to. There's a very nice article on Bloomberg by Angie Mukherjee, and interestingly seems to be highlighting the fact that I think, as you mentioned, the regulator says, the high-frequency trading giant made $4.3 billion from India in a little over 2 years, but they've only been investigating trades in one index. So there's clearly a lot more to explore. But it's also interesting to see that, Jane Street and XTX are having a little bit of a blow-by-blow kind of conversation around this. What I would say is there's a more macro theme here, which is the important role of market makers in providing liquidity and how much that changed after the global financial crisis, when basically the leverage was taken out of the banking systems. A lot of the proprietary trading desks left after the Volcker rule. And you think about now today, how do we think about bringing liquidity not just into the traditional markets, but as you're starting to see others calling for, investments in private assets, in alternate investments, where will the liquidity come? We're going to need new ways to try and approach. Thank you very much.
Okay, so actually, Robert, I'm going to throw it straight back to you then, because obviously you just talked about private assets and so on. You're in London today. You're adopted home from the USA. Tell us, explain to me a little bit about what's been going on today, because there's obviously some very, very exciting developments in the UK finally coming through as a result of what 2 Lord Mayors ago's original initiative to try and drive greater investment in the city. And we've seen a very, very tangible result today, which I think we'll open up to the panel in a second.
Well, certainly. Sir Nicholas Lyons actually made a special guest appearance today at the Merchant Taylors Hall, which is one of the grand livery companies here in the City of London, where there was a big event hosted by the Chartered Institute for Securities Investments, where they announced the signing ceremony that had been done on Friday between the CISI, the City of London, and the Worshipful Company of International Bankers to try and promote an education, raising the visibility, because the best way to protect investors is to inform them. While many of the pension funds, I think there are 17, have now signed up to the Mansion House Accord in 2025, which follows Sir Nicholas Lyons' kind of first call to action in 2023. He told us the anecdote about having been the chairman of Phoenix, which is one of the biggest pension asset managers in the UK. How important it was for people to think about, now that we're in a world of no longer final salary pensions, but direct contribution pensions, to think about what it means. And in fact, this goes back to a very important paper. You might recall in 2001, there was a famous Wise Men report that was commissioned by the European finance ministers that said, governments can't afford old age Social Security. We have to rely on the financial markets. And what they observed was, from the mid-'80s to the 1990s, assets in the U.S. were growing about 10 and a bit % versus 6 and a bit % in Europe, while back at that time, you had roughly similar GDPs between the kind of Europe, including UK, and the US, but the population was larger in Europe. Why? Why was this lower growth in assets? And one of the reasons was the high cost of trading, clearing, and settlement across border. So that led to what became Markets in Financial Instruments Directive, MiFID. Some people thought MiFID stood for Many Investment Firms Find It Difficult, but actually that went live on the 1st of November 2007 to try and actually harmonize the framework, particularly as things became much more electronic, to scale business across the marketplace. But when you come now, within that report, there was a very famous page 74 that said, if the average job career, it lasts 40 years, and people want to retire on, say, a third of their salary, well, if they can achieve an investment of just 2% above real returns, each individual is going to have to basically invest 20% of gross salary every year for 40 years. And the reality is, ladies and gentlemen, that people are just not doing that. So in 2023, when the Mansion House Compact was trying to encourage an investment into the UK of about 5% into UK private assets, that was really the lighting the touch paper to kind of raise the visibility, because nobody was talking about pensions. But today, 15th of July, 2025, everybody is talking about pensions. And now with the new government and the new people in, with our current Lord Mayor, we've now got a call for 10% of assets to be invested in these private assets and alternates by 2030. So what does that mean when we talk about private alternate assets? We're talking about real estate, infrastructure, private credit. And you might say, well, why? Why are people wanting to invest in that? Well, you only have to take a look at BlackRock's 2025 annual report, the chairman's letter to shareholders, where they're making the case that investing in real estate, private credit, infrastructure helps by assets lowering volatility, but with that long-term illiquidity return premium getting higher returns. And then you think about, well, what is the scale of the opportunity? Well, according to BlackRock, the amount of investment in private credit is going to double by the end of the decade. And for investment demand in infrastructure alone by 2040, it could be 68 trillion. So clearly, it's an opportunity for people to take advantage of, but we're going to need new ways to think about access and liquidity for these types of products. Tonight, we've got the Chancellor speaking at the Mansion House to talk about what will be coming next. Also today, we had more announcements around the support of the government for financial markets in digital assets, including the support for what's called the digital gilt, otherwise known as the digit. And of course, part of the wholesale financial markets digital strategy includes things like a pledge to completely dematerialize the financial markets. Let's end the reliance on papers and faxes. Let's have a commitment to end-to-end automation and interoperability with kind of the T+1 initiative, which happened in America about a year ago, but is scheduled for the 11th of October, 2027 here in the UK, Switzerland, and Europe. So there's a whole load of opportunities that are being raised in the visibility of the industry here on the 15th of July, 2025. Thank you.
Wow. So, Mark, as an expatriate Brit now in Canada, what do you think of all of this sort of wildly hyperactive development in the City of London?
Well, I'm impressed that somebody is getting their act together and confronting the reality there in the UK, which is that the things are a bit of a mess, and especially this, as Robert very eloquently outlined, the situation with the pension fund. So, yeah, obviously this is to be welcomed, and it's part of a bigger, global trend, of course. I mean, the idea of investing in private assets has been around. Has grown in prominence over the last few years, but especially this year, it's become very very upfront. And if we're looking at the private markets in the US and the number of extremely large privately held companies like of SpaceX and Stripe that have come along in the last few years and continuing to raise capital to the point where there's speculation around what will be the first $1 trillion private company. Is that round the corner? I think it almost certainly is. So the need to now, the big problem with all of that, of course, is that these are private markets, and the retail investor and the person planning for their retirement has no access to them. I think it's very encouraging that there seems to be an appetite amongst the regulators in the US to let this thing evolve a bit and see where it goes. The idea of tokenization, to which I know that involves the blockchain and all of that kind of stuff, but in my opinion, that's not the key point about it all. It's not the tokenization itself. It's the fact that people are building instruments that will lead to you being able to invest in private assets, and there are some listed in the US right now. Listed. They're not listed as ETFs, I don't think, but they're securities that are where the funds in there are invested in private companies. So you can buy shares in those today on the exchange, but they're not terribly well formalized, and they may be liquid, but they're not covering as broad a scope of the private markets as one would wish. So this is to be supported, and like I said, I do think it's good that the SEC is watching and waiting to see how this evolves. Some interesting comments from Hester Peirce the other day, the commissioner there at the SEC, where she was actually a little skeptical about how far this could all go in a short space of time, that the idea of just because you've tokenized it and taken it out as a crypto thing, that none of it is subject to the securities regulations. I think she was pouring cold water on that to an extent. So it's very dynamic and a very interesting time.
It's also interesting, though, isn't it, to think about it? I mean, I don't know. Here we see an interesting oxymoron because, like, the world's largest private companies, there's something like probably things like, well, I think VTOL may be the largest of all at the moment, but it's got revenues like $400 billion. Cargill's have got revenues like, what, a couple of $100 billion, 175, something like that. So I think one could argue that we already have got trillion-dollar private companies, but, and here's the rub, ladies and gentlemen, the reason that one of the problems with them being private is that actually they're not achieving a transparent public valuation. So therefore, we always have this problem. And what do you reckon on the whole issue, looking at it from your wondrous perspective?
I don't know, Patrick. I think I'm a little bit still either skeptical or I just need more information as to how these things are going to work. But I go back to what I was talking about previously, that there's these arbitrage opportunities between regulated and non-regulated. Typically, the non-regulated, the companies involved are going to be making more money. They just don't have to follow the same rules. And as much as some of these securitized or some of these tokenized assets, if I hear properly, are securities, well, then they should be regulated under the SEC, and I don't quite know how that's happening really. And then you still have almost a turf fight between the CFTC and which as to what who has what responsibility. There's still questions about what is a security, notwithstanding the Howey test and so on. So, and I'm sure there's going to be more questions about that the more of these types of instruments that come into play. And one thing I haven't seen is except that I remember watching Scott Bessent, the Treasury Secretary, talk about stablecoins and how these would help in the retail sector, actually, for retail buyers to own our treasuries. Does anybody think about inflation and these types of, introduction of these types of instruments, or am I just imagining the boogeyman here?
Well, I don't know. I mean, I think when it comes to the pure tokenization of everything, my problem is I'm just skeptical as to why it needs a blockchain. I mean, that's just a dematerialized security, which I'm thoroughly behind Robert's wondrous news from the City of London that they're trying to dematerialize everything. Certainly the last thing we need are more fax machines or anything like that. But there is a certain degree of wondering why we have things settling one way. And I mean, Robert, you might like to opine on this because you've just been regulated as BPX, and in fact, you are both offering digital blockchain style securities and offering also conventional securities related to real estate.
Well, thank you very much. I think what one of the kind of moments of enlightenment that I had as a very young employee in the financial markets was on the life floor when we used to see each other. We know the identity of the other side of the trade. With the introduction of the internet, the electronification of the markets, the introduction of order books became anonymous, and yet there was still a lot of activity. And the question is, well, why are people still trading if you don't know who's on the other side of the trade? And the answer is, when you sign up to the rule book, you're basically signing up to the presumption of enforceability of legal contract. And that enforceability of legal contract, that presumption of enforceability, that confers trust and confidence in the market. And with technology, you can then scale. Now, I think what's interesting, I was just taking a look at a visual capitalist chart, which shows in 1995, the biggest company in America was a market cap in Q1 of $93 billion, which was GE. So you didn't have any trillion-dollar companies back then, but you started to get by 2020, I guess Microsoft became one of the first trillion-dollar companies. And of course, now you've got, Apple, Microsoft, and others, multiple trillions. And of course, one of the interesting insights in the UK is that, asset managers who might be allocating on like an MSCI World basis, the percentage of what the UK weighting used to be to what it is now is very small. So, it's interesting to see how those companies have grown. And one of the reasons why Amazon and Apple grew so large is their business models have been all about digitalization, right? Optimizing the workflow. So if we come to tokenization, what are we actually talking about? Tokenization is nothing more than, in my humble opinion, securitization with benefits. So if someone's got some money, some cash, which is central bank money, if you've got a £10 note, that's from the Bank of England. But as soon as you put it into a commercial bank, it's no longer your money. You now have a credit relationship, an IOU with the bank. Now, if the bank's got 100 and they keep 10 of capital, they can lend out that 90. But if they want to do any more, they have to basically package the 90 and sell it. That's securitization, we know. What you can do is, tokenization is securitization with benefits. So when you sell your assets, you get the money same day. You increase the velocity of money, right? You have the benefit of traceability. I remember when Lehman went down, everybody used to say, oh, who owes what to whom? Well, a classic product of the time was one of those, how many remember those capital guarantee products where you give 100 to your private banker and they say, oh, you'll get a product that gives you a share of the upside when the market goes up. But when the market goes down, you get your 100 back. So guess what? Lehman goes down, the markets are falling. You call up your private banker, say, hello, can I get my 100 back? They say, hold on, I'll call up the structure desk. The structure desk says, hold up, I've got to call up, for example, another bank that did the structuring. And the other bank says, I'm sorry, the guarantee of 100 was given by Lehman. Oops. So what you get today is you get a level of traceability, visibility that hopefully can help with some of those particular issues. Now, what was interesting for us is, lots of people have been talking about the manifestation of tokenization, which in my humble opinion looks a lot like a depository receipt or an ETF or a fund or a special purpose vehicle. Is a fund wrapping a bunch of assets. The units are giving you the fractionalization. But what's interesting is while lots of technical companies, fintechs have been very competent in the act of tokenization, if you're an institution and you want to be compliant, you're going to wait for an institutional grade regulatory permission in order to be able to participate. And it was really the watershed moment was when the Law Commission, which is the independent steward of the common law, 800 years of property ownership rights, published their report in the summer of 2023 that basically concluded in writing that, it was very simply paraphrased, the common law could accommodate digital asset ownership rights. That was the time we decided to set up BPX because we knew there's going to be a whole slew of things that people could point to in the public domain that could help them through governance processes. So, Patrick, you quite kindly mentioned we've just received a number of authorizations. Basically, for the last 2 years, we've been working on applications, and we've now been granted a multilateral trading facility license, an alternate investment fund management license. Because the DLT is part of that design, that's the trigger for applying for the crypto asset register for the FCA. But we've also been very grateful to have been approved by the Bank of England and the FCA in the Digital Security Sandbox. So learning from our friends in Switzerland who had an exchange, an SDX with maybe 2 sets of connections, we have through our legal first, digital first design, one connection to give you access to BPX into XClear because 6xClear had a risk profile, a risk committee that understands how to risk manage what we call illiquid instruments into CREST, so we can do the dematerialized, but through the same connection into the Bank of England and Digital Security Sandbox, where in that environment, which has been enacted into law, one can technically disapply certain rules in order to innovate. And subject to the oversight of the Bank of England and the FCA is as long as we meet their criteria, and we're going through a Gate 2 application right now, then we should be able to go into production. So this is a very important inflection point. I would say, 1995 was very significant in introducing the internet and electronifying the markets. 2025, I feel, is another inflection point, but it could be even bigger and larger with more benefits if we get it right. Thank you very much.
I think that's a great point about the inflection point, and it's very interesting because I'm totally with you in terms of securitization with benefits. I've always been there for the securitizing of pretty much everything, because if you turn it into an asset, then it's something that you own and you've got the right to lend it to somebody, but essentially the custody chain should be a lot clearer. I'm not particularly convinced, and I remain unconvinced that actually a blockchain is the best way to go about doing that, and despite having been a very, very early pioneer in the whole blockchain thing. Mark, what do you reckon?
Yeah, I mean, I think the existence of securitized assets today that trade very liquidly on many, many markets, but the one I watch most closely is the US. The fact that we're already there suggests to me that there's nothing stopping this evolution from continuing and from people packaging other assets into securities with a ticker symbol that trades on the exchanges, just like an ETF does, just like all these many, many securitized instruments do today. And I must admit, from a personal point of view, I mean, not from an institutional point of view, I think the system works extremely well already. So in a way, I think the door is already open. And I agree with you, Patrick, that a blockchain infrastructure is not essential to facilitating the growth of this trend. Now, I fully accept, Robert's observations about the immediacy and the ability to transfer in real time, and all of that. And I'm sure there are, in the future that day will come, and there will be great benefits to doing that. But I think that we already have an infrastructure that can make this happen. What's needed is a legal backing for growing the securitization market, to facilitating new assets to come in, to be inserted in there and allowing people to trade them, improving the transparency. All of that is essential. But as far as infrastructure is concerned, like I said, I feel like we already have a pretty good infrastructure to start work on this right now. Not saying that we shouldn't continue evolving it in the way that Robert's described, but we don't have to wait for that day, let's put it that way.
Interesting. I mean, Anne, I'm curious what you might think about this. Go ahead, sorry.
No, I just, I was thinking that, to Mark's point, that we had the growth of securitization right during the Clinton administration, the modernization of a lot of these rulings, so that then you had the collateralized mortgages, which of course got a bad name because they were associated with the housing, the financial crisis of 2008. Commodities also, I mean, those started being securitized, and I'm talking about the commodity futures, were securitized into products that were then sold by, the brokerage firms as partaking in commodity upward movements, because basically they were all had a long bias. So if you bought them, they should go up. And that's, at least in commodities, has not proved, for some commodities, I should say, we'll put aside the copper market for the time being. But, corn is the same price as, it was cheaper than it was back in 2008 when the commodity market started moving up with the food crisis. And that got, of course, a lot of flack because the securitization of commodities was blamed for this huge sector, which were registered as under the CFTC as swap dealers, really, that were peddling these products to retail public. It all came. It didn't come crashing down, but nobody made money on these things. So I have that as my background to look at this upcoming securitization, and I think I'm probably in the wrong. I'm in.
Well, I think not, though, because it's interesting. It's interesting, Anne, sorry to interrupt, but it's interesting because we've seen recently, like a lot of people are suddenly, for some reason in Singapore, we've had several mentions recently of people looking to tokenize all sorts of commodities. And I'm really kind of lost there, because I just don't see how adding something and making a kind of a crypto token necessarily makes it any better than previously. Didn't we spend decades trying to get to warehouse receipts?
I think exactly. It's something like that. That you actually have a warrant on a commodity, a real commodity, whereas the securitization of commodities just allowed people to buy shares in the security, like the Tukurum Corn Fund, also Deutsche Börse, the Ag Fund. At one time, I forget what the capitalization was, but it started off with a big bang, and then it just slumped thereafter, and it's still in the slump if it's, because it's mostly tracks all agricultural commodities, which just haven't done anything. It turns out commodities are very, very supply responsive. So you raise the price, and the farmers will find a way to plant more. And we now have, when I first started, this is way back in the 1970s, the United States was the grain exporter, period. You didn't have any, Argentina and Canada, yes, contributed, but basically it was the United States. Russia was the primary buyer, especially of wheat. This is when the great grain robbery took place. And Brazil didn't exist. When I first started trading, I started to trade a few cargoes out of Brazil as an exporter, but that was a brand new thing, and they were going into Europe. So I bring it up because all of that has changed so much. That's just like so many eras ago, because Russia, that was the biggest buyer, is now the biggest exporter of wheat in the world. And of course, they've got Ukrainian land where they can take the commodities grown there to ship out as well, to earn, income on their war machine. And you've got the United States, instead of being number one, it's like number three. Brazil is the biggest in corn and soybeans, and Russia is the biggest in wheat. It's just been an astonishing turnaround of the fortunes of the United States.
It's also a fascinating turnaround, as you say.
A little off track here, but
no, but with Russia, it's also interesting because there we go, comrades, all those 5-year plans, and everybody was still starving, and they had to import huge amounts of the stuff, and suddenly everybody got capitalism, and strangely enough, they grew enough that they could even export it.
Oh, absolutely. And, of course, they have the biggest, the greatest land in the world, this Chernozem. It's in Ukraine. I worked in Ukraine in 2013, right before the Maidan Nezalezhny revolution, where Yanukovych was booted out. But they didn't have infrastructure. Ukraine still did not have a barge system to ship grain down the Dnieper River. And the reason why it doesn't is because the railroads are subsidized so extensively by the Ukrainian government that it's always cheaper to ship by train. Another holdover from communism, I guess you'd call it. So, at any rate, yes, they developed their infrastructure pretty well. The storage, particularly, there's these bags storage now. Instead of having some sort of steel bin to put your grain in, which is very expensive, there's these harvest bags that are supplied at fairly cheap, and they can be put onto a truck and brought to a larger elevator. But you're right, Patrick.
And it's interesting.
You're right about that. That communism, had destroyed the infrastructure, destroyed the profit incentive, and had not just a 5-year plan, but everybody had their little tiny plot of land, so there was no scale to take advantage of. And ironically, the biggest farms in Ukraine are now something like 500,000 hectares, because the land was consolidated through leasing. They just finally have opened up the land to actually sales. There was a moratorium on land sales for forever. So I agree with what you're saying.
Actually,
it's really interesting as well. Go ahead, Mark. Go on.
Well, more generally, just to around commodities, I mean, that story that Anne has told there of Russia and what they've done to make things more efficient. I think that applies across the board, doesn't it, in commodity production? That there is always, if you like, some degree of downward pressure on commodity prices because of improved efficiencies, exactly along the lines of what Anne was saying. Now, this reminds me of the famous Julian Simon bet, about a basket of commodities. What will their price be in 10 years' time? And I think it was, it doesn't matter who that was with. I think it was that Doomster. Was it Ehrlich? Paul Ehrlich was the other party to that wager. Yes. And it turned out that Julian Simon was right, and the commodity prices were going down. And that was my experience for a while in the early 90s. I was in metals trading, and I remember then the price of aluminum, depending on the audience, at that time was like in real terms was the lowest it had ever been. And I dare say that's true of many, many commodities. So what does that say about commodities as an alternative asset? In a diversified portfolio, is it true generally to say that it's a bad bet and you should, avoid being long of it and instead be long of the lowest cost producers who will be able to extract the most value out of that commodity, because of their pure efficiency?
Well, but you don't want to be long the price trackers then. I mean, these price trackers, as I say, the securitized futures just track the prices. And if you go to the most efficient supplier, then you're going to have, the U.S. has the lowest prices of corn and wheat in just about the world. But the main thing that contributes to commodity pricing, in my opinion, is government policy. And it might be ad hoc government policy, such as what India did when they shut down the wheat contract and then they declared a moratorium on exports. So wheat prices stayed at $5. Well, let's call it $250 a ton, which is the language everybody else speaks, unless you're an American like me. And then, but the wheat prices in Chicago went to triple that, because it was the only market in town that was freely traded. All the other countries shut down their wheat, including Russia. I think there might have been some. And then you've got Argentina, that despite Milei, who I'm a big fan of, Javier Milei, there's still taxes, export taxes on Argentinian soybeans, and I think wheat and corn too. It's the only country in the world other than, Russia also taxes. But Argentina has a perennial tax on their commodity shipments. And the reason is because they can. Because the government can collect money that way. It's a very easy collection because they can track all of these shipments out of the port.
Yeah, it's fascinating. And you go back all the way to the 70s and you had that Malthusian delusion, which was always being propagated by the likes of Paul Ehrlich, and all the similar sort of really, really defeatist tones that were coming out at about the time that bet took place, and driven by, it drove forward places like the World Economic Forum, which anyway, less said of that the better, probably. But we've got 10 minutes left, team, and I suppose we should just have a very brief delve, although I suspect it's going to come up again in September. We're going to have August off, ladies and gentlemen, around here. Tariffs. Now, it looks to me Donald Trump has re-engineered the entire world, although everybody seems to keep saying he's losing. I'm just curious what you think is happening in the tariff debate at the moment, given the fact that the European Union certainly seem to be not retaliating. There are deals with China, Vietnam, and the UK, and indeed also there's a lot of talk about transshipment, which I think is possibly going to be one of the words of the year when the appropriate dictionaries come to record that. What do you reckon, Anne?
In 10 minutes? I don't think we've seen the end of what might come of the effective tariffs. And just very simply, let's take the copper situation, where all of this copper has left London vaults and come into the COMEX market at about a $2,000 a ton, I think, premium. Maybe Robert and Mark know a little bit more than I do about the exact price differentials, but These are ad hoc interventions, I call them, and they distort markets. I mean, there's no reason for copper to come to the United States except for the tariffs. So suddenly there's all of this copper in the U.S. That will. But if you pay, I just can't get it through my head to think that okay, you're in some industry that produces things with metal, and you have to pay a 50% markup or 30 to 50% markup in your raw materials, and then you turn it into something magical that everybody can afford. I just don't see it. And I go back to India, another place I worked. The average GDP per capita there is $2,800. So, to the idea that somehow we're going to change the trade deficits with that type of discrepancy in national incomes is kind of lunacy. And I don't mean to pick on this one particular part of the Trump agenda because I favor several of his policies, but I think we haven't seen the net result of this one.
Interesting, Robert. What do you see on the tariff agenda at the moment?
Well, you called out a term, transshipment. I was thinking, what on earth is transshipment? So I've just looked it up. So for all of us, ladies and gentlemen, transshipment is the shipment of goods or containers to an intermediate destination, then to another destination. So it sounds like transshipment is being used because people are thinking of, is it a way to short circuit the tariffs? Well, what I can say is from a humble practitioner point of view, the tariffs that have added volatility have probably given a gift to those exchanges that have order books that obviously scale with volatility. But what is the real insight there? The insight is the importance of liquidity. And I think it comes back to your point, Patrick, where you said one of the benefits of securitization is you own an asset and you can lend it. And Mark, as you said, what we really need is not necessarily a technology like a blockchain, but what we need is kind of a legal framework, right? Well, the legal framework, which can be manifest through the traceability of an asset, that's one of the advantages of something like a blockchain or a DLT that could probably get around transshipment. But actually, just go back to the point of, the benefit of tokenization is really to mobilize assets that can become eligible collateral so you can generate liquidity. You can use the collateral, you can recycle it for generating some liquidity without having a sale, without having a tax event. And let's just take a step back and think, the giant bond market has become even bigger with all the printing. And if you think about the high quality liquid assets of treasuries, gilts, and bunds, they're pretty active buying and selling and using, right? Okay. But when you start taking a look at corporate bonds, right, even on FCA, UK FCA regulatory statistics, the average number of trades of a corporate bond in a year is about 0. But isn't it interesting to observe that when you wrap those corporate bonds in a fund structure, fixed income ETFs are amongst the most liquid instruments that are trading in the Paris exchanges around the world. However, sometimes
I'm going to pick a bone with you.
Okay, go ahead, go for it,
Robert. I'm going to pick a bone with you. Vietnam, the United States has a trade deficit of about $120 billion. That was almost zero just a few years ago. So what's been happening is that the finished goods from China are going into Vietnam or in the port, and then the bills of lading get changed and so on, and then they come into the United States. So it's like you stamp out one little fire and then it ignites over here. So I'm not sure that your solution really applies to this problem.
Well, I would just like to answer that.
Trump is trying to solve the problem of the deficit. Okay.
No, I'd like to, because I think you highlighted the point, the bills of lading, right, which is the old English word for loading the ship when you have container ship from one port to another. The reason why in the law in September of 2023 we had passed the Electronic Trade Documents Act, which basically said anything that anybody can endorse INDORSE, like a wet signature with a pen, you can do it electronically. So we don't need wet signatures anymore on legal contracts like promissory notes. The bills of lading, which are vastly paper-based and probably open to a bit of fraud, you help clean that up when you make it electronic. And when you look at the the ICCC, which is trying to come up with a digital framework and add provenance into the electronic bills of lading, I think you can start to address your very valid point, Anne, because when you got loads of paper and people can move things around, it becomes more difficult when you have that traceability. Thank you.
Okay, it's just not going to happen overnight. I mean, especially in these
not overnight, for sure.
They don't have to.
Well, I think the interesting one there is, of course, I think actually that's a great topic to come back to in September, because there's some really, really interesting nutty article ideas around it. But Mark, why don't you offer us the last word for today, whether it's on tariffs or whatever you'd like to discuss?
Well, I think let's stay on the same topic. We can. There are other interesting things happening, but we can raise them when we have more time. So, I mean, the story with the tariffs seems to be that everybody, literally everybody outside of Trump's inner camp, thought this tariff thing was a terrible idea and would very quickly lead to inflation and lead to all sorts of turmoil. And yet it hasn't happened yet. I mean, the way that the topic even doesn't make it to the top of the news agenda nowadays, even though he's still going around throwing 50% here and 50% there, suggests that the market itself has kind of come to terms with it. And all the expert pundits that wrote endlessly about this and predicted that the worst was just around the corner. I mean, they are now saying, well, just wait and see. This quarter doesn't really count because people brought forward their purchases of imports and so on, but as soon as this cycle is through, we're going to see an impact. So it will be interesting to look at this. I would say the end of quarter 3, when you look at corporate results and inflation and all the other measures, will the damage manifest itself by then? And if it does not, are we not maybe just living in a new world where tariffs are a thing like they have been in the past, and rightly or wrongly, everyone learns to live with them, and we move on to some other, controversy? I don't know. So, but I feel like that's the point at which maybe you can start to make proper judgments about the effect of all this.
Can I just add?
Go ahead, Anne.
The problem, a lot of the problems with the tariffs is that the WTO did nothing about tariffs in the emerging markets. So those tariffs kept going up and up and up, and the U.S. tariffs kept very, very low. So I think this is what Trump is correcting, is the deficiency from the WTO that would take years to settle these trade disputes. I'm not talking 2 years. I'm talking 5 to 7 years. So we were living with tariffs. We just didn't realize that they were against the United States mostly.
Yeah, and I think the issue there is also it is one of transshipment, which is which has obviously worked very, very well for China, exporting stuff to Thailand and other places, possibly adding some value in those places on the way through. And that was obviously the core of the Vietnam trade deal that's been done. And indeed Mexico. I mean, Mexico is essentially a massive transshipment assemblage hub for all sorts of manufacturers around the world. And you can see how that's been clearly vexing the Trump view of the world, whether you agree with him or not. But that's the situation. We're going to talk more about tariffs, ladies and gentlemen. We're also going to address in our next show, and I'm so sorry you're going to have to wait till September, but Amit Desaya, thank you so much for your great question about AI. We've made a note of it, and our bot is going to remind us so that when we have the panel back in September, we're going to discuss that amongst a multitude of other things, including, I suspect, tariffs are going to be still on the agenda because, well, they'll only be roughly about 30-something days old if they all come in on the 1st of August, as Trump suggests. It only remains for me, ladies and gentlemen, to say a huge thank you to our electric panel today in alphabetical orders by surnames. And good grief, this was Sesame Street. Today was B. B for Barnes, Dr. Robert, and Berg. B for Berg, and it was a pleasure to see you. Mark Beddis, and I got those in the wrong order alphabetically after all of that. Well, there you go. That's what happens when you're young and you get to the end of the alphabet. You don't really care. Thank you so much, all of you, for making this a fantastic and terrific show. We're going to be back next week with just a one-on-one. I'm looking forward to it. It's the final show of the year. We're sort of academic year, as it was. Digitizing Carbon, IPO-VID 182. We're going to have a returning guest, Steve Zwick, the man who knows everything about carbon markets, or so it always feels to me. That's going to be next Tuesday at 12 o'clock Eastern, same time, same place. I look forward to that. The panel's going to return in September. We're going to be having our holidays in August and taking some opportunity to try and rest and relax. And I want to say, finally, a huge thank you to our brilliant production team today, AJ, Desiree and Jamil. And don't forget, catch PhD tomorrow, which will be hosted by Jamil Navarroza. She's got a fantastic woman talking all about the wonders of finance and financial markets and investment, particularly through the gaze of the woman. And that's going to be a great show. My name is Patrick L. Young. Thank you again, once again, to Mark Beddis, Dr. Robert Barnes, and Berg, our three fabulous guests today. The panel will return in September on our next path. And my name is Patrick L. Young, and I want to say on behalf of myself, the entire team, and obviously how much we miss Beata Young, I wish you all a great week in life and markets. We'll be here again next week.